Imagine you're walking down the street, and suddenly a shift happens, a change in the financial world that you didn't see coming. The way the global economy works is evolving at a rapid pace. From the rise of digital currencies to the increasing push for sustainable investing, the trends we see today will shape the financial future for decades to come. Today, I'm going to break down some of the most important global finance trends that are affecting all of us right now, and how you can adapt to this ever-changing landscape. Welcome everyone to today's deep dive into the world of global finance trends. If you've been wondering how the global economy is shifting and how that will affect you as a consumer, an investor, or an entrepreneur, then you're in the right place. In this presentation, we're going to explore some of the most significant global financial trends, understand their causes, and discuss how they impact the future of money, investments, and global economies, especially here in the United States. Before we get started, I'd like to remind you to subscribe to this channel and hit that notification bell. I'm aiming for 1,000 subscribers, and with your support, we can grow this community and continue having insightful conversations on important financial topics. Now, let's dive into the world of global finance and explore the trends that are changing everything. The surge of inflation across the globe. One of the most talked about financial trends right now is global inflation. Inflation refers to the rising cost of goods and services over time, and in recent years, it has been a topic of major concern worldwide. In fact, inflation rates across the globe have reached levels not seen in decades. This surge. The pandemic served as a massive disruptor, sending shockwaves through the global supply chain, causing bottlenecks in production, delays in delivery, and shortages in key goods. On top of that, government stimulus packages injected trillions into economies, spurring demand while supply was constrained. This imbalance led to demand pull inflation, where too much demand outpaced the supply of goods and services. Additionally, the war in Ukraine has intensified food and energy inflation, particularly in countries like the United States, which rely heavily on imported oil and grain. So, how does this affect the average consumer and investor in the US? Well, the cost of living continues to rise. Everyday expenses like food, gas, housing, and healthcare have all seen price hikes. This means that the purchasing power of consumers is weakening. In response, the Federal Reserve and central banks worldwide are looking at how they can curb inflation by tightening monetary policy, including raising interest rates. The role of cryptocurrencies and blockchain technology. Let's shift gears to another game changer in global finance, cryptocurrency. Once seen as a speculative asset, cryptocurrencies like Bitcoin, Ethereum, and Ripple have grown into key financial instruments that are challenging traditional banking systems and fiat currencies. At the heart of this revolution is blockchain technology, the decentralized ledger that underpins cryptocurrencies. This technology has the potential to disrupt everything from banking to real estate, supply chain management, and even voting systems. As we continue to see more institutions, from hedge funds to governments, engaging with cryptocurrencies, the question remains, is crypto the future of money, or is it just a passing trend? While some investors see cryptocurrencies as a hedge against inflation, others remain wary due to their extreme volatility. One of the key advantages of crypto is that it operates independently of traditional financial systems. This means that even if national currencies are devalued due to inflation, cryptocurrencies could potentially offer an alternative store of value. However, this decentralized nature of crypto comes with its challenges. Regulatory concerns are mounting, especially with stablecoins and decentralized finance (DeFi) platforms, which are challenging the role of traditional banks. Governments are now contemplating how to regulate crypto and how to integrate it into their financial systems without jeopardizing the stability of traditional currencies. Geopolitical risk and its impact on global markets. Now let's turn to geopolitical risks, which have always played a pivotal role in global finance. The world has seen significant geopolitical shifts in the past few years. Trade wars, political instability, and conflicts, such as the Russia-Ukraine war, have sparked economic repercussions that ripple across borders. These geopolitical risks have contributed to higher commodity prices, disruptions in supply chains, and market volatility. For example, the war in Ukraine led to surging energy prices, especially in Europe, and also significantly impacted the supply of wheat, given that both Russia and Ukraine are major exporters of this commodity. These geopolitical tensions are also driving protectionism, a policy where countries prioritize their own industries over foreign competition. This trend is having a ripple effect on global trade, and U.S. businesses are increasingly forced to adapt by adjusting their supply chains. In some cases, companies are looking at reshoring or nearshoring, bringing production back to the U.S. or to nearby countries in Latin America to mitigate risks. For investors, the challenge is to anticipate how these geopolitical risks will affect global markets. Stock prices, commodity prices, and currency value fluctuate rapidly depending on how global political tensions unfold. The impact of tariffs, sanctions, and changing trade policies should be at the forefront of any global investment strategy. The increasing importance of ESG investing. In recent years, there has been a noticeable shift in the way investors are thinking about their portfolios. The rise of ESG investing, which stands for Environmental, Social, and Governance, reflects a broader desire to align financial decisions with personal and societal values. While ESG investing started as a niche concept, it's now going mainstream. According to the Global Sustainable Investment Alliance, the total amount of assets managed with ESG criteria has reached trillions of dollars. In fact, it's becoming increasingly difficult to ignore these criteria if you're involved in investing. Why is ESG so important? Investors are realizing that companies with strong environmental practices, ethical governance, and social responsibility not only perform better in the long run, but they also contribute to a more sustainable future. Consumers are also becoming more conscious of how companies impact the environment and society, and they're willing to put their money where their values are. As a result, the demand for sustainable products and services is rising, and investors are now looking for companies that prioritize these factors. For U.S. investors, it's clear that ESG considerations are no longer just about doing good. They're also about making good financial decisions. Companies that focus on sustainability are better positioned for long-term growth. And investors who adopt ESG strategies may not only feel better about their portfolios, but may also benefit from higher returns in the future. The evolution of interest rates and central bank policies. As we discuss global finance, we can't ignore the role of central banks, especially the U.S. Federal Reserve, in shaping the economy. For years, the Federal Reserve maintained ultra-low interest rates to support economic recovery after the Great Recession and, more recently, the pandemic. However, as inflation rises and the economy begins to recover, the Fed is shifting its stance. The question on everyone's mind is, what will the Fed do next? Raising interest rates will have far-reaching consequences for consumers, businesses, and investors. Higher rates typically make borrowing more expensive, which could slow down consumer spending and business investment. On the other hand, rising interest rates could also attract foreign investment into U.S. assets, which would strengthen the dollar. For investors, the direction of interest rates is critical. Bond prices, for example, tend to fall when interest rates rise, while the stock market may experience volatility as investors adjust their portfolios to account for higher borrowing costs. It's important to stay informed about central bank policies and how they'll impact the broader economy and specific sectors. To wrap up today's discussion, we've seen how global finance trends, from inflation and cryptocurrencies to geopolitical risks and ESG investing, are changing the landscape of the global economy. The interconnectedness of markets and economies means that the decisions made in one part of the world can have profound effects everywhere else. Whether you're a consumer, an investor, or a business leader, it's essential to understand these trends and how they'll shape our financial future. As we move forward, the challenge for all of us is adapting to these changes. The financial world is evolving at a fast pace, and staying informed and making thoughtful decisions will be key to navigating the complexities of tomorrow's economy. If you want to stay ahead of these trends and continue learning about the forces shaping our financial world, don't forget to hit that subscribe button and join this growing community. Thank you for tuning in today. I look forward to discussing more global finance trends with you in future videos.